To our YouTube channel. In this video, we're going to talk about a few recent changes made by SEBI in IPO rule. So let's begin. The first time a privately held corporation sells shares to the general public is through an initial public offering. Companies that go public raise money through IPOs for a variety of purposes, including operational capital, debt repayment, acquisitions, and a host of others. By completing an online IPO application provided by stockbrokers and banks, the investor can apply for initial public offering stocks in India. Online IPO allocations for UPI-based offerings are available through brokers, and banks provide both UPI and ASBA IPO applications. Now let's have a look at a few recent changes made by SEBI. SEBI introduced revised allocation method for HNI or NNIs. SEBI introduced two new categories in HNI segment: SHNI, small high net worth individual, and BHNI, big high net worth individual. By SHNI, we mean an investor who is eligible to apply for an IPO allocation which is allocated by a lottery system. Also, the SHNI group is entitled to 1/3 of the HNI quota. Investors may apply for as few as 14 lots and as many as 66 to 67 lots under this category. If the IPO is oversubscribed, investors can purchase a minimum of 14 lots through a lottery. Say business XYZ is doing an IPO and 15 crore is set up for HNIs. Therefore, in accordance with the rule, 5 crore will be set aside for SHNI, allowing a maximum of 238% to purchase a minimum of 14 lots. Now let's talk about BHNI. An investor who can apply for an allocation through a lottery-based method is referred to as a BHNI. BHNI who invest more than 10 lakhs are eligible for 2/3 of the HNI part. Investors must invest a minimum of 68 lots in this category. In this category, if the IPO receives more subscriptions than expected, investors will receive a minimum of 14 lots. For instance, suppose that company XYZ is conducting an IPO and that 15 crore is set aside for HNI in this IPO. 10 crore reserved for BHNI per norm. In this IPO, there is a maximum lot allocation of 476 persons. The various distributional probabilities for allocations are presented below. Prior to this new regulation, HNIs received IPO allocations on a proportional basis. For instance, if investor A applied for 100 crores worth of shares in company XYZ's IPO and that amount was oversubscribed by 100 times in the HNI category, then investor A would receive 1 crore worth of shares in proportion. Now let's talk about the lock-in period for anchor investor. The current 30-day lock-in period will continue to be in effect. A 90-day lock-in period from the date of allotment shall be applicable for all IPO for 50% of the portion allocated to the anchor investor and the remaining portion. As a result, there may be less price volatility after the initial public offering. Since 2019, retail investors are able to participate in IPOs by using the Unified Payment Interface, that is UPI, with a bid maximum increase from Rs 2 lakh to Rs 5 lakh. Up to 5 p.m. on the day of the IPO's closure, retail investors can apply via UPI. SEBI learned that several institutions and high net worth individuals are trying to increase the IPO subscription. Instead of investing, their major goal is to grow subscriptions. SEBI is required to take this harsh action in this circumstance. All the IPOs that enter the market after September 1st, 2022 will be required to abide with this regulation. Actually, all investor funds have so far been banned on an ASBA basis. For IPO bidding, SEBI has established categories such as retail, eligible institutional buyer, and non-institutional investor. In reality, SEBI has learned that several recent IPO applications had to be withdrawn because investors lacked sufficient funds in their accounts. NBFCs are prohibited from lending more than $1 million per borrower for IPO financing, which will result in a significant oversubscription among HNIs. This will guarantee more steady and long-term funding for IPOs. Then the last one is offer for sale category. Shareholders who own more than 20% of the pre-issue stock may offer up to 50% of their holdings, whereas shareholders who hold less than 20% of the pre-issue stock may offer up to 10% of their holdings. This is done to actually prevent investors from owning shares purely to exit the markets through IPO. So that's all for today. We hope that you liked our video. If you are new to this channel, please do subscribe and hit the bell icon, and don't forget to like and share this video. Thank you so much for watching.